I'm Debbie Matz, Chairman of the Board of the National Credit Union Administration. Welcome to the second in NCUA's three-part series explaining the evolution and the eventual resolution of the crisis that has afflicted the corporate credit union system. In the first segment, we discussed the history of the corporate system, the services corporates provide to consumer credit unions, and the inner workings of how payments are made among financial institutions. In the second segment, we describe how the problems in the corporate system developed. And later, in a third segment, we'll outline the status of corporates today and explore ideas about how what has come to be known as the corporate crisis will be resolved. We recognize that some of the details may seem complex, but we're committed to helping you understand how the system works so that you can make informed decisions about the corporate's future. Thank you for taking the time to explore these ideas. We trust that this explanation will be helpful as the credit union community, together, decides how to move on from here. You can be reassured that at NCUA, as the regulator of America's federal credit union system, maintaining the system's safety and soundness is our highest priority.
Welcome to the second installment in the series of presentations on the current situation with the corporate credit union system. In this installment, we'll take a look at the types of investments that were held by the corporates, how these investments were affected by the downturn in the financial markets, and how the problems with investments affected the corporate credit unions and threatened the entire credit union system. Before we start, let's address one of the first questions on most people's minds. Everyone wants to know who or what caused the current problems. When a global financial crisis of this magnitude occurs, it is difficult to assign blame to one specific party or action. There are many separate but interlinked actions that took place that led to the economic problems that emerged in 2007 and 2008. There were many different actors that were involved. Corporate credit unions made some mistakes. NCUA made some mistakes. The list goes on and on. A lot of time could be spent trying to place blame, but that would not change the fact that we are facing significant problems that must be addressed. There is plenty of blame to go around, and some very significant lessons to be learned. Going forward, it is essential that we minimize the losses to credit unions and take action to reduce the possibility of such a crisis taking place again in the future. This slide summarizes the two primary problems facing corporate credit unions. As we go forward through this presentation, we'll review more specifically the issues that created the situation. However, the bottom line is that several large corporate credit unions made investments in private label mortgage-backed securities that are now worth much less than the amount the corporates originally paid for them. This affected corporate credit unions in two significant ways. First, it impaired the ability to assess sources of liquidity as they historically had done, as described in the previous installment of this presentation. Second, the corporate credit unions recorded losses on the mortgage-backed securities that threatened their solvency. In some cases, the losses were absorbed by the retained earnings and capital of the corporate credit unions, including the paid-in capital and membership capital held by their member credit unions. Throughout the remainder of this installment of the presentation, we'll address these issues in detail. As we noted, the current problem is due to the high concentration of investments in private label mortgage-backed securities held by several corporate credit unions. The table above shows the 5 corporate credit unions with the largest concentrations of private label mortgage-backed securities. We'll go into detail about mortgage-backed securities and the impact that the economic downturn had on them in the next few slides. The table provides a clear picture of the increased vulnerability to these 5 corporates from any problems in the real estate mortgage market. Western Corporate Federal Credit Union, WestCor, and the U.S. Central Federal Credit Union, U.S. Central, had 70% and 57% respectively of their total investments in private label mortgage-backed securities. We will explain what a private label mortgage-backed security is on the next slide. Before we proceed, let's get an understanding of what a mortgage-backed security is. Through the process of what is called securitization, a purchasing entity aggregates many mortgage loans into a pool and then issues a security backed by the pool. Said another way, a mortgage-backed security is created from hundreds, if not thousands, of mortgage loans. When a financial institution makes a mortgage loan, it charges interest to the borrower. When the borrower makes a monthly mortgage payment, Part of the payment goes towards paying down the principal balance of the loan, and part of the payment is an interest payment. The principal and interest paid from the underlying mortgages is used to pay the principal and interest owed to the mortgage-backed security investor. To create a mortgage-backed security, mortgage loans are purchased from banks, credit unions, mortgage companies, and other mortgage loan originators. The mortgages are purchased by government-sponsored enterprises, primarily the Federal National Mortgage Association, commonly known as Fannie Mae, and the Federal Home Loan Mortgage Corporation, commonly known as Freddie Mac, which create what is commonly referred to as agency mortgage securities. Additionally, many private institutions, such as brokerage firms, may also purchase mortgage loans to create what are commonly referred to as private label mortgage securities. As noted on the previous slide, there was a high concentration of corporate credit union investments in private label mortgage-backed securities. The agency and private label mortgage-backed securities are then sold in the financial market to investors. The investor is hoping to earn a profit off the cash flows from the mortgage loans in the pool. There are risks involved when investing in a mortgage-backed security. The borrower may refinance the mortgage loan or pay off the mortgage loan early. This results in investors being paid back more quickly, which may result in a less than expected overall income. The borrower may stop paying on the loan, which will reduce or eliminate the principal repayment to the investor, or the value of the real estate on which the loan was taken may significantly decline, which may impact cash flows as well as the value of the securities. The entities that create the securities take some steps in the creation process to try and reduce the risk to the investor. We will discuss those in greater detail a bit further in this presentation. This slide provides a visual representation of a very basic mortgage-backed securitization created by Fannie Mae and Freddie Mac. Fannie Mae or Freddie Mac purchases the loans from a financial institution to create the mortgage pool that backs the security. Fannie Mae and Freddie Mac also provide certain guarantees and, while not backed by the full faith and credit of the U.S. government, have special authority to borrow from the U.S. Treasury to support the guarantees. The guarantees they provide and the ability to borrow from Treasury reduce some of the risk to the investors. The investors purchase the right to receive the timely payment of interest and ultimate payment of principal from the pool of mortgages. The security represented in the diagram is a relatively low-risk investment, as it is issued by a government-sponsored enterprise and has guarantees the investor will receive payments. As we noted in the previous slide, not all mortgage-backed securities are issued by a government-sponsored entity. Some mortgage-backed securities are issued by private entities, and these securities are referred to as private label mortgage securities. Private label mortgage securities do not have the guarantee of the government, but they are created with other types of enhancements that offer some level of protection to the investor. We also indicated earlier that the corporate credit unions had invested in a significant amount of private label mortgage-backed securities. Let's take a look at the benefit to the various parties involved in the securitization process and why some investors would choose to invest in private label mortgage-backed securities. Up to this point, we have described what a mortgage-backed security is and how it is created. It would now be helpful to understand how this transaction is a benefit to the parties involved. Let's first take a look at how the transaction benefits the credit union or other financial institution that originally granted the mortgage loan to the borrower. These institutions are referred to as originators. As we noted previously, there are risks associated with mortgage loans. We pointed out that the borrower may prepay the loan, or the borrower may slow down or fail to continue to make payment on the loan, and the value of the property may decline. These risks are passed on to the investors when a credit union or other financial institution that issued, or what is called originated, a loan sells it to the financial markets. An additional risk that consumer credit unions and other financial institutions that originate and hold mortgage loans have is called interest rate risk. Interest rate risk occurs when there is a change in interest rates. Here is an example of how a change in interest rates would affect a consumer credit union that holds mortgage loans. Let's assume that a borrower has a fixed rate 30-year mortgage and is paying the credit union interest at a rate of 6%. At the time the loan was issued, the credit union was paying a 5% rate on its share deposits. The 6% interest income on the mortgage loan covers the 5% interest expense on shares and allows 1% to cover operating expenses and build capital. If interest rates in the financial markets rise to 8%, the credit union will lose money on the loan. That is because the credit union will need to pay 8% on the member share deposits to keep them from going to another institution that pays the current market interest rate. However, the credit union is still only earning 6% on the fixed-rate mortgage loan. Not only is it not earning enough to pay the 8% share dividends, but it is not earning enough income on the loan to cover operating expenses or build capital. A major benefit to the loan originator selling mortgage loans for use in the securitization is the ability to restructure the institution's balance sheet. In other words, the composition of assets the institution holds on its books. Mortgage loans are very long-term in maturity in comparison to other loans or investments a credit union might have on its balance sheet. A large concentration in mortgage loans exposes the credit union for a long period of time to the various risks associated with mortgage loans that we discussed earlier. Additionally, we just finished discussing the issue of interest rate risk. A credit union may have a large concentration of fixed-rate mortgages and may decide to sell them in order to eliminate the impact of changing interest rates. Selling the mortgage loans transfers the risk to other parties. Often, the credit unions can continue to service these mortgages on behalf of the investors, which can be a source of revenue and provide the credit union with the ability to maintain the relationship with the member. Finally, credit unions are in the business of meeting the borrowing needs of their members. If a credit union maintains a large volume of mortgage loans until the loans mature, it has less funds available to provide new loans. When the credit union sells its mortgage loans, it can use the proceeds of the sales to fund new lending opportunities. Mortgage-backed securities benefit investors in that they provide opportunities for investments with different levels of risk. Mortgage-backed securities have traditionally been relatively safe investments. There is a desire in the financial markets for this type of investment, which pays a fairly stable return over an extended period of time. However, mortgage-backed securities can also be structured during the securitization process to offer a higher level of risk for individual investors seeking such investment opportunities. In this slide, we will discuss the various means by which securities are created for the benefit of those investors looking for lower risk investment products. In the next slide, we'll look at some ways in which securities were created to appeal to investors looking for a higher level of risk. We already discussed the guarantee that goes with securities issued by government-sponsored agencies. Issuers of private label securities take different steps to reduce the risk associated with the securities they issue. For an investor looking for lower risk, the securitization can be structured to provide credit enhancements to make the investment less risky. Credit enhancements include, for example, insurance wraps, reserve accounts, and over-collateralization. An insurance wrap is a pretty straightforward concept. The security includes an obligation from an insurance company that the investor will receive the expected principal payments. The companies that provide this type of insurance are called monoline insurers. The financial health of a number of monoline insurers has declined, threatening their ability to make good on their insurance obligations. Some corporate credit unions have experienced losses due to the failure of two monoline insurers, Financial Guarantee Insurance Company and AMBAC Financial Group, to make payments on securities they guaranteed. The insurers were forced to suspend claim payments due to deficits incurred from extraordinary payouts. An example of a reserve account is a specific amount of funds set aside to absorb a level of losses before the losses would be passed on to the investor. And finally, over-collateralization means creating a security backed by a pool of mortgage loans greater than the value of the investment. For example, if the mortgage-backed security sold in the market for $100,000, there might be a pool of mortgage loans in the amount of $110,000 backing that security. The value of the mortgage loans in the pool could fall by 10% before it would impact the value of the security. Credit enhancements reduce the risk to the investor and will also earn the mortgage-backed security a higher credit rating. We will discuss the importance of credit ratings shortly. Some investors want a greater return on their investment, and as such, they are willing to take more risk. Credit enhancements reduce risk, but they come at a price. Those investors who desire less risk are willing to pay the price for the credit enhancements. Usually, that price is a reduced rate of return than the rate of return for investors who did not take the credit enhancements. During the securitization process, high-risk pieces of a security can be created through a process called subordination. We will discuss subordination next. As we noted on the previous slide, a way in which the creator of a mortgage-backed security can create different levels of risk for investors is through the use of subordination. Subordination is a process by which certain slices of the investment, called tranches, absorb losses before other higher priority tranches. Thus, when mortgage loans default, first losses are absorbed by the lowest priority tranche. As losses increase, they are absorbed by the higher priority tranches after the lower tranches are fully utilized. We'll soon take a look at a very simple example of subordination, but let's first take a look at what a credit rating is, how it works, and how it fits in with the issue of subordination. Most investors do not have the time or resources to perform a thorough financial analysis of the securities in which they would like to invest. Traditionally, investors have relied on credit ratings provided by nationally recognized statistical rating organizations, NRSROs, often referred to as rating agencies, as part of the decision process when considering an investment. A credit rating provides an assessment of the credit worthiness, or more simply, the financial condition and prospects for a security available in the financial market. Corporate credit unions are required to perform their own independent review of a security prior to purchase. The NRSRO's credit rating is one part of their analysis. Credit ratings are assigned by the rating agencies such as Moody's, Standard & Poor's, and Fitch, based on the review of the structure of a security. For a fee paid by the entity that creates the security, the credit rating agencies perform a thorough review of all aspects of the securitization. The review includes analysis of the mortgage loans in the underlying pool of assets, and also any credit enhancements that we discussed in the previous slides. The credit rating agencies are expected to provide the potential investor with an unbiased and objective summary of the quality of the security based on the credit rating it assigns. Credit rating agencies have come under criticism over the past 2 years as a result of the many highly rated securities that were later downgraded significantly. Credit ratings are generally a letter designation. Each of the credit rating agencies uses a slightly different letter rating system. Just for review purposes, the rating system used by Standard & Poor's ranks from excellent to poor, starting from AAA and going down to single D. Securities rated below BBB- are deemed to be non-investment grade, sometimes referred to as junk bonds. As we discussed earlier, the process of subordination provides for the breaking up of the cash flows of a security into different pieces. The different pieces can be assigned different credit ratings or no credit ratings in order to appeal to investors with different appetites for risk. This slide provides a visual example of securities created using subordination as a means of providing different levels of risk. It is simplified for discussion purposes. The lower portion of the box is the subordinated tranche, the tranche that absorbs first losses. The credit rating agency reviewed the securitization and, in part, due to the subordinated 15% piece of the securitization, assigned a AAA rating to the 85% of the security in the top priority tranche, also referred to as the senior position. The investors in the senior position will receive their cash flows before the investors in the subordinate position. In effect, the investors in the subordinate position shield the investors in the senior position from any losses until such time the losses exceed 15%. Historically, mortgage-backed securities experience no significant losses. Thus, the 15% subordinate piece would be considered enough of an enhancement to allow the credit rating agencies to assign the 85% piece a AAA rating. In theory, on a very basic look at the security created in the example, as long as the projected principal losses do not exceed 15%, the holders of the AAA rated piece of the security would be safe from losses. Unfortunately, in the current unprecedented financial crisis, losses far exceeded subordinated tranches, placing the senior tranches at risk of loss. In many areas of the country, especially in areas like California, Arizona, and Florida, home values fell 40% or even more. When defaults occurred, the underlying collateral values were insufficient to protect investors from losses. The holders of the AAA portion of these securities found themselves absorbing huge and unexpected losses. In the previous installment of these series of presentations, we explained that corporate credit unions were required to comply with Part 704 of NCUA's Rules and Regulations. The investment section of the rule sets forth the minimum requirements that a security must meet at the time of purchase. There are a number of requirements set forth in the rule. One of the requirements is the permissible credit ratings. In general, corporate credit unions were restricted to purchasing securities with credit ratings of AAA and AA. When the investment requirements for Part 704 were implemented, a thorough review was performed on the history of credit ratings and their success in evaluating the financial strength of marketable securities. The loss history of securities with an initial rating of AAA or AA was less than 0.5%. The loss history of securities issued by government-sponsored entities and the loss history of private label securities was virtually the same. While corporate credit unions were not allowed to rely only on credit ratings, the track record of credit ratings in evaluating the future performance of securities was historically strong. Credit ratings have been an investment decision-making tool in financial markets for decades. However, as we noted earlier, credit rating agencies have come under criticism as of late. The securities seem to be highly marketable. At the time corporate credit unions bought them, they could easily be sold in the financial markets or used as collateral for borrowings. We will discuss this in more detail later in the presentation. All of the mortgage-backed securities that were purchased by corporate credit unions were permissible at the time they were acquired, and accordingly met the rating requirements. We have noted previously that a key function of a corporate credit union, and one of the primary reasons that the corporate credit union system was created, is to serve as a liquidity provider to consumer credit unions. Historically, mortgage-backed securities fit well into the corporate credit union's business function as a liquidity provider because there was an active market for mortgage-backed securities and they could be used as collateral for borrowing. Up until the current economic crisis, there was an active market for mortgage-backed securities. Corporate credit unions could rarely buy or sell securities in the financial markets, depending on their liquidity needs. When corporate credit unions had excess funds on deposit from the consumer credit unions who were their members, some purchased private label mortgage-backed securities with those funds. The securities offered a better return and were historically just as safe as many other investment products. The earnings from the securities were passed on to member credit unions in the form of dividends on share deposits, or helped subsidize the fees charged to consumer credit unions for the services, such as settlement provided by the corporate credit union. Or in times of low liquidity, corporates could turn to the financial markets to sell the securities. Since sales of mortgage-backed securities were common and since they historically performed well, corporates could relatively easily sell the securities without incurring a loss. Another way that corporate credit unions could use mortgage-backed securities as a means of obtaining liquidity was to offer them as collateral on loans. As we noted in the previous installment of this presentation, the Federal Home Loan Banks and Federal Reserve discount window are alternative sources of liquidity. Financial institutions can borrow from those entities to meet liquidity demand, although the Federal Reserve discount window has historically been a lender of last resort. Only due to the current global liquidity crisis has the discount window been more flexible in this regard. Both the Federal Home Loan Banks and the Federal Reserve discount window require collateral in the form of a highly rated securities. Rather than selling mortgage-backed securities to meet short-term liquidity demands, corporates could borrow funds using the securities they had purchased as collateral. The securities would be returned to the corporate once the loan balance was paid off. Over the past few years, the Federal Reserve held interest rates at record low levels. As such, investors earned very low returns on government-issued debt. Corporate credit unions were looking for a higher return in order to continue to pay dividends at the rate consumer credit unions expected, and to fund the various services they provided to consumer credit unions. Additionally, as we noted in the previous installment of this presentation, national fields of membership for corporate credit unions were approved in the late 1990s. This introduced a new level of competition among the corporate credit unions to pay even higher dividend rates. Many corporate credit unions chose to purchase senior positions in these private label mortgage-backed securities. The senior positions were highly rated at the time of purchase and had a significant level of subordinate positions to absorb the first losses. Based on historic performance, there appeared to be very little risk with the private label mortgage-backed securities purchased by the corporates. Finally, many of the securities paid interest based on a floating rate rather than a fixed rate. This helped corporate credit unions in the overall management of their investment and share portfolios and mitigate the risk of changing interest rates. As interest rates rise or fall, a corporate credit union could change its dividend rates on shares accordingly so that it continues to pay a current market rate. As interest rates rise or fall, a floating rate investment's rate of return will also adjust. If the investments were fixed rate, when the interest rates rise and the dividend on shares is increased, there will be less income after dividend expenses earned from the investment. In a worst-case scenario, the rate earned on the investment would be less than the rate paid on the shares. In such a case, the corporate credit union would lose money. In general, consumer credit unions maintain their funds in corporate credit unions on a very short-term basis. At the end of a business day, a consumer credit union may deposit any funds it does not need for lending or operational purposes into the corporate. The corporate invests the funds in the financial markets. The consumer credit union earns a small return on funds that would otherwise have earned nothing, and has access to those funds from the corporate the next day. As we discussed in the previous installment of this presentation, consumer credit unions also maintain short-term funds in the corporate to meet the settlement demands for the various payment system transactions of their members. When the time arises for a check to clear or an ACH payment to be made, the consumer credit union must have the funds in its account at the corporate to cover those funding demands. As we discussed earlier, corporate credit unions function as aggregators of credit union funds. A corporate credit union with the consolidated funds from a large number of consumer credit unions has a greater number of options for making investments than does an individual consumer credit union investing on its own. While a corporate credit union maintains a significant portion of its funds in overnight investments, we also noted how investing in longer-term mortgage-backed securities could fit into its overall role of liquidity provider. Mortgage-backed securities generated more income than overnight or short-term investment opportunities and were thought to also provide a source of liquidity by being readily saleable or capable of being pledged as collateral. The added income allowed corporate credit unions to provide a higher dividend on consumer credit union share deposits. Income was also used to offset some of the service fees corporates charge their member credit unions, as corporate credit unions traditionally offer a higher level of hands-on service and assistance. As also discussed in the previous section, the income from the securities enabled corporate credit unions the ability to purchase the equipment and hire staff to handle the processing of various activities that allowed many consumer credit unions to offer more financial services than they could on their own. To understand what happened to cause the losses associated with the private label mortgage-backed securities that were held by the corporate credit unions, we need to now take a look at the overall global economic crisis that emerged in 2007 and 2008. In the early part of the decade, making home ownership a possibility for as many Americans as possible was an explicit public policy priority. Government programs and financial institutions increased their efforts to assist consumers in making home purchases. The strong economy fueled consumers' ability to purchase homes. As a result, home prices rose rapidly, resulting in what is known as a housing bubble. Basically, that means that the extraordinary increase in real estate prices was not sustainable. The impact of the real estate price growth on the national and global economies was significant. The demand for housing led to a huge increase in construction. The construction industry created a significant number of new jobs. Financial institutions found it difficult to keep up with the demand for funds to meet home borrowing needs. To raise additional funds, they sold their mortgage loans. As we described earlier, the mortgage loans were aggregated into pools to be securitized and sold to investors in the financial markets. There was a strong demand for mortgage-backed securities, both government-sponsored and private label, by investors as the expected return was far greater than what could be earned on government-issued debt, given the historically low interest rates set by the Federal Reserve. Many homeowners found that the value of their residence had increased significantly. More and more consumers wanted to be part of the real estate boom. More and more investors wanted to purchase mortgage-backed securities. However, most consumers with good credit had already purchased real estate. There were fewer and fewer consumers seeking mortgage loans that could demonstrate a good credit history and the ability to repay. Some financial institutions began to extend credit for real estate purchases beyond the credit worthiness of the borrower. In other words, the borrower could not document the financial ability to make the loan payments. Mortgage loans to individuals with demonstrated credit worthiness granted using conventional loan underwriting standards are referred to as prime mortgage loans. Mortgage loans to individuals that cannot demonstrate credit worthiness are not granted using conventional loan underwriting standards are referred to as subprime mortgage loans. The commonly held belief was that real estate values would keep rising. If a borrower could not make the payments, they could sell the property and pay off the lender. Or, if the lender had to foreclose, they could sell the property at an amount equal to or greater than the outstanding loan balance. There were other non-traditional mortgage loan products introduced at the time to help fill the demand for non-credit-worthy borrowers. The loan products include Alternative A mortgages, known as Alt-A, which allowed for less stringent loan documentation loans, non-verification of income, lower credit scores, or higher loan-to-value ratios. Investor demand for mortgage-backed securities also remained high. More and more mortgage-backed securities contained pools that included subprime mortgage loans. The growth in real estate prices could not be maintained. When high-risk borrowers could not make loan payments, they found they could not sell their homes at a price high enough to pay off the mortgage loan balance. Many mortgage loans were granted with adjustable rates that had a low interest rate to start. After time, when the interest rates reset and the monthly payments increased, many borrowers could no longer afford the payments. A large number of subprime mortgage loans were forced into foreclosure. The great number of foreclosures created a large volume of properties available for sale. The greater supply of properties caused further decreases in real estate prices, leading to more foreclosures. Real estate construction, which had become a very large sector of the economy, declined significantly. This led to a higher unemployment and even more borrowers unable to pay their mortgages. The subprime mortgage loan problem spread into the prime mortgage loan sector as once credit-worthy borrowers lost their jobs. The decline in value of real estate and increased foreclosures had a devastating impact on the mortgage-backed securities. The value of the real estate loans backing the mortgage-backed securities declined to a point that were lower than the value of the security. As more and more borrowers stopped making payments on their mortgage loans, the cash flows of principal and interest that created the payment streams to pay investors did not keep up with the original projections. While the issuers of the private label mortgage-backed securities utilized credit enhancements and subordination in an attempt to mitigate the risks, the decline in cash flows and in the value of the properties overwhelmed subordinated pieces. The holders of AAA securities found themselves facing unprecedented declines in the value of the investments. As the value of mortgage-backed securities declined, the historically strong markets to buy and sell mortgage-backed securities became inactive as investors became uncomfortable with the safety of the securities. Lenders became less willing to accept mortgage-backed securities as collateral for borrowing. These events had a significant impact on most financial institutions, including the credit union industry. Corporate credit unions' ability to use their mortgage-backed securities as collateral to borrow funds as a means to provide liquidity came to an end. They were stuck with huge amounts of mortgage-backed securities and could not sell them for a price anywhere near to what they paid for them. The problems were compounded by the accounting treatment required on these securities. We will discuss the impact of the accounting treatment in the next few slides. We previously discussed what a credit rating is and how it is used as one tool in the decision to purchase an investment. This chart provides a very clear picture of what happened to the credit ratings of the investments held by corporate credit unions as the economic crisis began to develop in 2007 and worsen in 2008. The chart also demonstrates the rapid deterioration in the credit ratings in late 2008. There was very little time for the corporate credit unions to try to sell their mortgage-backed securities before the ratings and values began to deteriorate. In June 2007, 99% of all securities held by corporate credit unions were rated AAA or AA. Only 1% were rated single A or BBB, which is still considered investment grade in the financial markets. There was a slight decline by December 2007 and a bigger decline by June 2008. However, by December 2008, the severity of the financial crisis was much more evident. Only 76% of the securities were rated AAA or AA, and 14% have fallen below investment grade. We discussed earlier that corporate credit unions were able to use mortgage-backed securities and their overall business model as a liquidity provider by being able to readily sell the securities in the financial markets or by using them as collateral for borrowing. However, as the real estate crisis began to grow, and as more and more investors became concerned with the safety of mortgage-backed securities, the mortgage-backed security market was mobilized. There were no buyers for those securities at any price. When the market became inactive, corporate credit unions were unable to find buyers at other than highly depressed prices, and the low market values for the securities almost completely eliminated their use as collateral. Without the ability to easily convert their mortgage-backed securities to liquidity, corporate credit unions found it increasingly difficult to function as liquidity providers to consumer credit unions. The situation deteriorated to the point where a few of the largest corporate credit unions could not conduct settlement activities on behalf of the credit union system without assistance. Had settlement activities not taken place, consumer credit union members' checks would not clear. The reputation of the individual credit union as well as the credit union system would have been seriously compromised. An early indicator of the developing problems with the mortgage-backed securities was an increase in unrealized losses on the balance sheets of the corporates. This is an accounting term and a requirement under generally accepted accounting principles, GAAP. GAAP requires an entity on an ongoing basis to obtain a price for what an investment would sell in the financial market. Unrealized losses on securities are reported on the balance sheet but are not recorded through earnings, nor do they count against capital. However, they represent losses that would be recognized through earnings and capital if the securities were sold. This accounting treatment is intended to provide full and fair disclosure to anyone reviewing an entity's financial statements. In December 2008, unrealized losses were approximately $25 billion for the corporate credit union system. Corporate credit unions could not sell the securities without being forced to realize the unrealized losses. It became of paramount importance for corporates to tap any and all liquidity sources to prevent the sale of securities and avoid realizing the unrealized losses. Putting additional pressure on liquidity was the outflow of funds from corporates due to the lack of confidence among their consumer credit union members of their financial health. Corporate credit unions became reliant on borrowings and also became less able to meet their members' liquidity needs. A corporate credit union solvency is measured in terms of capital. From a regulatory perspective, many corporates did not reflect concerns initially because losses were unrealized as discussed above. Many experts thought the unrealized losses were a short-term response to market disruptions. Even the credit ratings for most of the mortgage-backed securities held by the corporates remained AA or higher through June 2008, indicative of the highest credit quality. In the latter part of 2008, the perception had changed, as investors understood actual principal losses were going to occur. These principal losses were considered other than temporary impairments, OTTI, and had to be recognized according to GAAP. OTTI losses resulted in significant erosion of capital in corporate credit unions. At this time, all capital at U.S. Central, Westcor, and Constitution has been fully depleted due to projected credit losses. We will take a closer look at OTTI on the next slide. Before we proceed, it is important at this point to discuss the agency's position on depleting capital. The position is based on legal, regulatory, and accounting requirements. By law, all corporate credit unions must report their financial statements in accordance with GAAP. So if GAAP requires a loss to be recognized, then a corporate will record the loss. Per NCUA regulations, when losses occur, they are first absorbed by retained earnings. If all retained earnings are depleted, then the corporate must deplete paid-in capital and membership capital invested by the credit unions until retained earnings are restored to zero. It is this convention that has resulted in consumer credit unions writing off their capital investments in corporate credit unions. The investment losses and the lack of liquidity threaten the ongoing viability of the corporate credit union system and their ability to continue to provide critical financial services to their member consumer credit unions. Such an occurrence would put the entire credit union system at risk. On the previous slide, we discussed the losses corporate credit unions experience due to other than temporary impairment, or OTTI. Let's take a little time to discuss in more detail the concept of OTTI, as this forms the basis for the losses at the corporate credit unions. This discussion will not be exhaustive, as this is a very complicated accounting issue, but hopefully the information will provide you background on how OTTI losses are determined. As we noted, OTTI is an accounting requirement under GAAP. The premise for OTTI is that certain price declines are not temporary, but reflect fundamental losses in a security that are considered to impair the security's long-term value. Credit risk is the potential for the investor to receive less principal through maturity than had been expected at the time of purchase. Commonly, it is the credit risk that results in OTTI. The credit losses associated with credit risk are recognized through earnings. If insufficient earnings exist to cover the total amount of the losses, then capital is used to absorb the amount of the losses remaining. Significant price declines that endure for a period of time are the first indicator that OTTI may exist. The next step is to perform projections on the bond performance to determine if there are any fundamental causes for the price declines. In the case of the corporate credit unions, they used internal credit models and contracted with third-party vendors to project the credit performance of their mortgage-backed securities. In making these projections, the credit analysis looks to the underlying mortgage loans. Assumptions are made as to how many loans will default and, when defaults occur, the amount of the loss that will be recognized. Losses on mortgage loans occur when there is insufficient equity in the property to cover the cost of foreclosure and satisfy the existing mortgage loan balance. The projections then must look at the security and project losses through the various tranches. Credit enhancement factors must be considered, such as subordination or insurance wraps, as discussed earlier. When a credit loss is expected to impair a tranche, the investor most likely will record OTTI as a loss. These credit loss projections in corporate credit unions have indicated that substantial credit losses are likely. Accordingly, many corporates have had to record OTTI. In particular, Westcor has recorded over $8 billion, and U.S. Central has recorded nearly $3 billion in OTTI. These losses have resulted in all capital being depleted at these two corporates, and the respective members of these corporates have had to impair their investments in Westcor and U.S. Central capital accounts. This chart reflects the magnitude of the OTTI losses and the impact on capital at the 5 corporate credit unions with the most significant losses. Not surprisingly, these 5 corporates are the same that were identified earlier as having the largest concentrations of mortgage-backed securities. Both Westcor and Constitution have no capital remaining. U.S. Central has capital, but that includes a $1 billion note deposited by NCUA. Deducting the NCUA capital note, U.S. Central would also have a deficit in capital. Both members, United and Southwest, have lost all of their retained earnings in approximately 65% of their member capital accounts. The losses at the corporate credit unions have been significant. In the next installment in this series, we will take a look at how much the losses at the corporate credit unions are projected to cost the consumer credit unions and why. In this installment of the presentation, we have explored the causes of the current problems with the corporate credit union investments in private label mortgage-backed securities. We looked at how a mortgage-backed security is created, and how these types of securities were intended to be used by corporate credit unions to facilitate their role as liquidity providers for consumer credit unions. We discussed some of the factors that led to the economic crisis that emerged in 2007 and 2008 and its impact on the mortgage-backed securities held by the corporate credit unions. And finally, we identified the effect the crisis had on corporate credit unions' ability to serve as liquidity providers and why they were forced to recognize losses on the securities, even though the securities were not sold. Going forward, it is essential that we minimize the losses to the credit unions and take action to reduce the possibility of such a crisis taking place again in the future. In the next installment of this presentation, we will turn to NCUA's efforts to stabilize the corporate credit union system and minimize the cost to credit unions and create a safer regulatory environment going forward.